Yeah, it's been a brutal week, but I think we're reaching peak uncertainty. There's a number of macro clouds and big questions out there. I think once the market sees that we're going to get clarity from the Fed next week, kind of move along in this hiking cycle, hopefully they kind of meet expectations at 50 basis points. And they could use a hand getting some peak data showing peak inflation. But once we see that profits aren't peaking, yields start stabilizing, I think some of the clouds move away and this market kind of goes back into the range bound. Fair to say we're at the low end of the range, but back into the trading range it's been in for much of this year.
Yeah, Keith, April 11th, you downgraded equities to neutral, and you were extremely positive on equities until you made that bold call. S&P is down 7% since then. How much more pain is ahead?
Well, great to be with you, Scott. It is a painful day at least. We think we probably still have a little bit lower to go. We probably have to break below these lows to get a little bit more capitulation. It is a positive that we've seen sentiment become very negative. Like the AAII shows the biggest spread between bulls and bears, or one of the biggest spreads over the last 30 years. So that's a positive. But the market coming into today wasn't extremely oversold. If we break those lows, I think we'll get a little bit more of that fear, and fears cause bottoms. As far as how low do we think we can go, we think there's pretty good support for this market around 4,000. That's a 17 multiple on the market. And I think even if you overshoot that, I think that will be probably a better risk reward if we get down there.
Does that sound reasonable to you? I mean, that's kind of the line in the sand for a lot of people, including the technicians. I'm looking at Adam Parker, who's sitting right next to me.
I've tested whether the bull-bear ratio has any predictive value for subsequent one-month return, and it doesn't. So I think it's one of those things where you try to find something to grasp onto that could tell you sentiment's bottoming. The answer to your question is I have no idea. So I'll pick, if you pick 4,000, okay, that sounds like some arbitrary level it could be. I don't know. All I know is that corporate earnings are going to be higher. And ultimately, you're just if we get to 4,000, then you're going to have a really low multiple for some quality equity. So I have no idea where it'll capitulate. But what I do know is that the conditions that we're seeing from the largest corporates give me confidence earnings will grow for longer than other people. So I'm getting increasingly bullish as prices come down. But I know bull-bear ratio doesn't have any two-week or three-week predictive value for the equity market. So does him.
No, but Marci, the problem is
Scott.
Yes, please. I'm sorry, Keith. Please.
My point was not the next week or two. All I'm saying is that you have sentiment. People have been saying, hey, the sentiment's negative, including us. But you haven't seen that kind of flush out from the market. All we're saying is, hey, sentiment's already negative. In Adam's point, corporate earnings have held up pretty well. If you break below these lows, you'll get more of a flush out. And I think we have good fundamental support for this market around the 17 multiple. Doesn't mean we're going to exactly get there, but I'm just saying you put that together and the risk reward becomes more attractive, both from a fundamental and a technical perspective.
What do you think?
I don't. Yeah. Okay. I mean, I don't know. I don't know what flush out means. So if 4% down in one day isn't a flush out, then I can look at
last Friday.
Right.
Felt
so
like
what we could do is we get what you're really saying.
And it wasn't.
What a quantitative person would say is there's a price momentum signal. When the stock's down a certain amount, what's the distribution of subsequent returns following that price? I don't think the work will show that there just aren't that many markets to point to where we go down 10, 15%. So you have to ask yourself, is this like 08? Is this like the European crisis? Is this like COVID? I don't see that sort of impairment. I'm not seeing tons of inventory impeding margin progress. The issues are around U.S. labor force, U.S. wage inflation, some rising commodities in various pockets that likely roll over. So I just don't see the impediments to think earnings are going to be down 10% next year. I mean, look, that's why I hear him. I think he's got some common sense in there. It's short-term price momentum. It's some sort of capitulation. But it's hard to measure those things quantitatively and predict subsequent return. So you got to step back and say, I just got 200 data points from corporates across consumer tech and banks. And what did they generally tell me? Pretty much that things are better than the prices of these stocks are telling you. So you've got to like stocks more now at 4:13 on Friday than you did Monday at 9:29.